Karnataka is India's ultimate startup destination with over 14,000 registered startups and 45 unicorns. Bangalore, proudly known as the nation's startup capital, ranks third globally in the number of startups, cementing its place as a powerhouse of innovation. The city also has 144 incubators and accelerators and 1500 plus VC funds. Karnataka's success is further driven by strong industry government collaboration, a bold entrepreneurial spirit, and cutting-edge R&D hubs of global giants. As we approach our global investors meet, I eagerly look forward to recognizing and rewarding the startups shortlisted through Venturize, our international startup challenge. Venturize is set to boost startup ecosystem and drive innovation and entrepreneurship across the country. Join us as we accelerate growth and shape the future through Invest Karnataka 25.
Hello and welcome. You're watching Business Today Television. I'm Sakshi Batra and this is Market Today, a show where we'll help you understand the closing action on the D Street. Well, last half an hour to go. It's been a painful day in the middle of the week. If you see 316 points lower right now and we are back inching closer to 23,000 odd mark. 1.3% fall for the Nifty. The Nifty Bank is also down over 1%. All the sectors are under the pressure. You're actually seeing even the broader markets feel the heat at this point in time, with the small caps losing almost 3.5% in trade today, especially some of the sectors like the realty index that's also down by over 3% in trade right now. In fact, the realty index has entered a bear market territory too. Does all of this have to do with Trump's tariff talk is something that we'll try and understand. We also have our guest joining in on the show. Mr. G. Chokalingam, a regular on the show, is with us. He's from Economics Research and he has a wealth of experience when it comes to tracking the markets and various cycles. Warm welcome to you, Mr. Chokalingam. Thank you for taking the time out. Well, it's very important for our viewers and key investors to understand what really is happening with the markets right now. We were hoping that the budget will come out positive. That did. We were hoping that the RBI would cut the rates. That happened. But despite all of this, the markets are not getting the confidence or regaining the momentum that they used to be at before these two major events that unfolded. Does it just have to do with the Trump tariff talk? Is that a big spoiler when it comes to the D Street sentiments?
Definitely, the Trump continuous aggressive protectionism measure is a trigger for market to fall. But I have been saying on the same channel for last few months, the market also need to understand the fact that a lot of retail investors have lost hell lot of money in chasing, the stocks with the bubble valuation. We saw so many new age companies, digital companies trading at 80p, 100p, while their year-on-year profit growth was not even half of that. So as of now, nearly 80 lakh crore of equity wealth has been wiped out from September peak, 2024 September peak. That itself is a major reason for this continuous correction, because the liquidity in the hands of many retail investors got dried up due to this 80 lakh crore erosion. And this 80 lakh crore erosion is roughly 25% of India's nominal GDP for the current year. So it happens this way, but of course, the triggers are Trump's measures, continuous rupee weakness, even the corporate earnings. It is in single digit. If you see more than 1,400 companies which announce the results, year-on-year profit growth is in single digit. So all these factors also, act as a trigger for market correction. Unfortunately, this correction might continue till mid-March or end of March 2025. But I still remain confident about market bouncing back, particularly small and mid-cap bouncing back in a very big way from April 2025.
Okay, got that. So, Mr. Chokalingam, at this point in time, what is the strategy that you advise most of the retail investors should adopt? I mean, most of their portfolios are bleeding at this point in time. A large part of their portfolios is, exposed to mid and small caps that are facing even a sharper brunt at this point in time. What is it that they should do? Should they avoid looking at the portfolios, let this play out and see whether things get back on track and then take a decision? A lot of noise is happening. Stop your SIPs, be cautious on your SIPs as well. The markets could be entering a bear phase. All of this noise, amidst all of it, what is the real strategy that investors must adopt?
Yeah, I do not agree with the view that it is not the right time for SIP. I completely disagree. Yes, I do agree that the mutual fund managers have limitations. They can't invest in a small cap, tiny cap, or even mid cap with poor liquidity. So therefore, their investment focuses on the top end of small cap or mid cap index stocks. Now, if you look at the small cap index stock, you have a say national aluminum, the market cap is 33,000 crore. So mutual funds, because of inherent limitation due to the concern for the liquidity, they tend to invest in the top end of the index stocks within small and mid cap. So that's a perennial limitation. Perhaps because of that limitation, this kind of talk has come. But for professional investors, individual investors who understand the market, who has long experience, those arguments are not at all valid. Yes, if you look at small cap index PE, it is even after this meltdown, it is 29 PE, trading PE. Mid cap index is 34 PE, trading PE. Definitely, if you look at this PE, nobody can say that you go aggressive after small and mid cap. But that is not the true picture of Indian stock market. You have 4,000 stocks in the small cap, and they are not homogeneous, they are heterogeneous with diversified business models. And there are so many hundreds of stocks which are outlier in terms of their respective PE as compared to small cap PE, which is 30, which is close to 30 now, or even in mid cap. So the point I'm trying to tell you is that uh, there are two types of pockets within the small and mid cap segment. One pocket is where the lot of institutional activities happen, and there the P ratios are 40, 50. Even now after the meltdown, there are many the stocks owned by mutual funds. They are trading at a 60, 70, 80 P also, whereas the profit growth is not even half of that. So then the other side, you have a segment where you have a lot of high quality stocks still available at 12 P, 14 P, 15 P, and time tested management, excellent balance sheet. So that is where the individual investor should focus. And let me tell you that after 80 lakh crore of meltdown, if you are not going to invest, when will you get the ideal time? Yes, my argument may go wrong. If Mr. Trump becomes directly against India's economic interest, things may go bad, but very difficult to predict. But history tells you that whenever such a major meltdown happened, if you have chosen the right stocks in terms of the management quality, balance sheet quality, durability of the business model, and the valuation comfort, you definitely you minimize the risk, and that is the way the wealth has been created. Like for example, I will give. I am not recommending at all. When we recommended BSE adjusted for bonus, it was 150 rupees. The institutional holding was very low, and the institutional coverage was very low. Now the stock has gone up by more than 35 times within 3 years. Now look at the institutional holdings. Look at the institutional coverage, so big. So that is where I am saying that the individual investors don't have to worry about the problems of institutions. You have a separate segment pockets within small cap and mid cap, where you have a valuation comfort, where you have opportunity to make a lot of wealth in the long term, say 1 to 3 years, and that is where you don't have a competition, with institutional players. So happily you can buy cheap, and when the story plays out, you can sell to the same institution after they go up 10 times, 20 times, and this is repeatedly happening for decades in the market, because the advantage the small investors have, the institution do not have. They cannot buy such stocks at such level because of the liquidity concern. So therefore, what my suggestion is that don't have a high debt and high exposure to equity. Even now, if you have debt, your focus should be to return the debt. And second, ensure that based on your risk profile, minimum 30 to 40% of your financial wealth is safeguarded in fixed income securities like bank deposits or government bonds. And out of that remaining 60% of the money, you can consider, around 50% after allocating 5-10% for, gold and silver. At least 50% you can consider for equity, and within that, depending upon your risk profile, you can invest 30-40% for large cap. Yes, large cap don't guarantee the return because, as I said, even now Sensex is trading at 21.5 times trailing PE, much cheaper than small cap, mid cap, but then erosion in wealth, they are also very high. But you can create a liquidity in no time by having exposure to Sensex and Nifty stock. So therefore, out of the 50% of your financial wealth, you put 30-40% in the large cap and rest you put in the small and mid cap. And four criteria you follow, as I said, the quality of the balance sheet, the least leveraging, least working capital crisis, valuation comfort, and time-tested management. And lastly, if it is a growth stock, if you are paying 50 PE, see that the profit grows, anywhere from 30 to 40%. So these are the criteria. If you follow, you are certain to, make a lot of money. Recall 2013 experience. 2010 to 13, there was a severe meltdown in the small cap. And let me tell you, a large number of stocks have given even 5 to 10 times return post to 2013. Similar thing happened in 1819 also. Small caps got a severe meltdown, and they created some phenomenal multiplier. So therefore, to conclude, I would say that don't shun small cap, mid cap, but see that your strategies are right, and you become a long-term investor with a minimum investment horizon of 1 to 2 years.
Okay, so then how do you look at the other asset classes which are kind of outperforming the stock markets by a huge margin? Gold, for instance, after that 26% surge in 2024, again has given 11% surge in the first 1.5 months of the new year alone, and experts are still bullish on higher, levels could be coming in very soon again. 90,000 could be coming in on gold is what the expectation is. Looking at how, again, what we started off talking, Trump tariffs, any kind of global uncertainties could cause. Are you bullish on gold and silver as well, sir? Do you think this is the right time to also diversify beyond equities?
I have been very bullish on gold till last year, but now also I am not bearish. But I would say that one can always have 5 to 10% for gold and silver perennially, particularly for Indian investors, because same gold for about 10-year time period in dollar term, it remained almost stagnant. So that experience also we have seen.
Yeah.
But times are changing. It is, its performance is always related to other asset classes and interest rate in the world. But still, one can always have 5 to 10%, perennial, like a real estate. Don't take this as a competing class with equity. How you treat like a real estate, you can have 5 to 10% in the household. Why? There is a very interesting insight about this, particularly for Indian investors. Post independence, the rupee always used to depreciate on an average 5%
Yes.
per annum. So 5% per annum. But in the last 15 years, that average trend got broken, but then rupee keeps depreciating only. So therefore, even if international prices of gold in dollar term do not move up significantly, you are certain to make at least this average return of 5% from the gold only because of possible rupee depreciation in the medium to long term. And therefore, one must have 5 to 10%, but don't take that as a competing class with the equity, unless, there is some episode like a COVID pandemic or sudden deflationary condition. Keep it as a perennial asset class like real estate.
Okay. When it comes to the sectors in the equity space as well, are you looking at any place where investors can hedge, look at a safe haven deployment if one still has fresh funds to deploy in this current weakening trend in the market? I mean, we are down by 4.5 months, the longest losing streak in the last 20 years. Many investors who have a long-term view are still actually looking at this as an opportunity. I mean, we are already down, 3,500 odd points from the all-time highs on the Nifty alone. And since we have seen that level, there is an expectation that at least from here we can retest those levels at some point, if not immediate. So looking at that aspect as well, which are the sectors that you believe once the tide turns, where can the outperformance begin from?
If tide turns, the outperformance once again will begin from the small cap and mid cap. But as I
Okay.
mentioned earlier, don't get again carried away by the segment of packets of these small and mid cap which are overvalued. But if you are a defensive and a safe investor in the short term right now, look at the domestic businesses. Because of this Mr. Trump factor, we don't know how things are going to play out on the external economic front. So therefore, and also, while FIs are going away, the retail investors are still coming to the market. You would be surprised. Last week, 6 lakh, more than 6 lakh new investors have registered on BSE. Prior to that, around 8 lakh investors registered. So it is somewhere 6 to 8 lakh investors are coming every week, even now. So therefore, bank on domestic business, bank on domestic investors, which means these investors normally chase the small and mid cap. So therefore, what I'm saying, allocate 30% in the large cap, something like banking sector and the aviation. Banking sector is purely domestic driven, and the business is still growing in double digit. And the aviation, because the oil price has corrected 10%, and it is primarily catering to the domestic passengers, and that is then FMCG sector. These are the three sectors in the large cap. But in small and mid cap, there are many stocks available at 10 PE, 14 PE, and domestically driven. There are some chemical companies which make chemicals only for to act as import substitutes, and there are e-commerce companies. In terms of valuation, extraordinarily cheap valuation. So you have a host of small and mid caps which are catering to the domestic business. So, like just to give an example, again in this market, I don't dare to venture to recommend because whatever quality stocks are falling. Just to give an example, like for example, FDC Limited, pharma company, we have also invested in the company. 83% of the business is from the domestic market. So the dependence on US or global market is the least. So this kind of approach you can follow, and if you look back the history, of course, history doesn't guarantee the future success. But if you look back history, whenever the first half the market gave a phenomenal return, and second half market gave a lot of notional losses, what happens? A lot of selling happens. A lot of people sell and offset the loss against the profit. So therefore, I believe that starting from this week to end of March would be ideal time to buy in phases good quality small and mid cap stocks, because history says post that selling pressure tapers off, the these good quality stocks likely to recover in a significant way from April. But only possible risk to this argument is if at all the US government makes a direct measures, economic measures against India, then this argument may go wrong. Or if a monsoon forecast becomes very adverse, and by any chance they project failure of monsoon, then this argument can go wrong. Otherwise, I am pretty confident because at 6.5% growth also, India would be the fastest growing economy in the world. So stay invested, don't get panic. You get panic only if you are invested in the wrong stock. Otherwise, don't get panic. And this happened many times in the last 20 years. So this are
Yes.
passed by.
I think the only thing that you should not do is not to panic in this current markets, and that's what Mr. Chokalingam has also suggested. This has happened many times over. Things will get better over time. What we'll do, viewers, is we'll break for a short duration. We'll take a short break, and when we return, we're going to be speaking to Mr. Chokalingam about the trends that could be important for you to watch out for in the markets going forward. Stay tuned.
I am proud to highlight Karnataka's crucial role in driving innovation in the aerospace and defense sector. Karnataka contributes to 65% of India's aerospace related exports and caters to 70% supplier base for India's aerospace and defense industry. Supported by robust infrastructure, skilled talent, and global partnerships, Karnataka is shaping the future of India's aerospace aspirations. Invest Karnataka 2025 will further solidify our state's position as a preferred investor destination for aerospace and defense companies.
Welcome back. You're watching Business Today Television, and this is Market Today. Just about 11 minutes remaining for the markets to shut shop. We are going to be ending on a fifth consecutive session in a lower note. I mean, you can see over a 300 points cut on the Nifty, although we are reviving from the absolute day's low, but we are still far away from the day's high point as well. 1.3% of a cut on the Nifty. In fact, when we look at the key stocks that are down, you have, barring 4 to 5 stocks, rest all of the stocks on the Nifty are actually down in the red. Aisha Motors is the top loser, 6.8% cut. Apollo Hospitals, Shriram Finance, BEL, Coal India, these are all the stocks that are down anywhere between 3 to 6 odd percent. The few stocks that are still hovering higher, Adani Enterprises, Grasim, Trent, Bharti Airtel remain to be the only stocks that are into the green. All the sectors are down in the red, with mid and small caps losing over 3.5% each. You will also have the real estate index that's down by 3 odd percent. Let's discuss this space also with Mr. Chokalingam, who's with us to help us understand the market sentiment. Mr. Chokalingam, real estate, last 3 to 4 years, we've actually seen a good enough performance coming in from the realty index. Things started to dwindle from June to July onwards after the elections, the space was very buoyant because of the huge demand in the luxury spaces, residentials that were, residences that were upwards of 100 crores, 200 crores. These kind of spaces were getting into huge demand vis-a-vis the affordable ones. And that was the sentiment booster for the real estate space as well. Now, with this, June onwards, from the time the peak happened in Nifty Realty, we are down 26%, which means the index has already entered a bear market territory. What exactly is your thought when it comes to the Nifty Realty space, sir?
One can wait for at least another month or so, because as I said, I expect market weakness to continue till mid-March or even end of March.
Yeah.
Particularly for real estate, one can wait because as I mentioned, the erosion in the equity wealth is now close to 80 lakh crore in just a matter of 4 to 5 months, and which is now 25% of India's nominal GDP. As a student of economics and also with my interaction with a lot of investors in the last 30 years, I learned that whenever such a major meltdown happens, definitely there is a demonstration effect in terms of the demand for the real estate, the automobiles and the durables. Obviously, you can't write off this kind of magnitude of wealth erosion, and definitely it will have some impact on real estate sector as well. So, and also even after this 26% correction, there is no great attraction if you look at the P multiple, price to NAV. So therefore, I would suggest at least wait for 1 more month before entering real estate stocks.
Okay, fair enough. I hope this has answered a lot of viewers' questions when it comes to the real estate space and the opportunities that exist there. In the broader markets, there are some interesting names that are pulling up. We have DCM Limited, that's up 7%. You have Red Tape Limited, that's up 6%. Then you also have a stock called Ceylon Exploration, that's up and about. Ujas Energy, at least 3-4 days in a row, this has been on a buzz at this point in time, but not the ones which we usually really discuss. Very rare, far and few between names that are up and about. What's down in the broader markets, you have a lot of them. Which are down by even 20%, 19, 18% odd or so in trade today in the broadest index. The ones that we could talk about are Goldium International, that's down 10%. Zagal Prepaid has been continuously declining. Godfrey Phillips, Panacea Biotech, KFin Tech is also down by about 10 odd percent in trade today. Dream Folks is down. Wellspun Investments, these are all the counters that are down in trade. Let's discuss the capital markets related story, which has been an otherwise outperformer, sir. KFin Tech, CAMS, CDSL, BSE you were talking about, sir. Brokerage houses names 361, Angel One, and even Edelweiss for that instance. All of these stocks have actually had a good run up. Your sense of how should these stocks be really looked at when the markets are in a downtrend?
Definitely, this entire space, exchange-related space, it's going to be a perennially growth story, no doubt about it. But definitely, the cycles in the stock market itself impacts their performance. So therefore, one has to be very choosy in selecting the stock. So among all these stocks, there's only one stock I can confidently recommend is CDSL. First of all, the stock has corrected almost 40%. Of course, just because it is corrected, I am not recommending. If you look at the data on depository, it has been consistently outperforming as compared to its competitor, and it remains as a solid growth story, and it would continue to remain as a growth story. The valuations are now extremely attractive, and if somebody wants to invest for 1 to 5 year or 1 to 10 year, I think this is one of the stocks one can consider, because stock exchange business, as long as mankind survives, the business will survive, and the depository business model is integral part of the exchange business, and you are getting CDSL at at the at a phenomenal after phenomenal correction at a very attractive valuation. So this is the one stock I would recommend. We also have a buy report. Personally, I do not hold, but we have come out with a buy report on this stock.
Okay, fair point. 5 minutes to go before we shut shop for the markets and the day. Mr. Chokalingam, anything else beyond the capital market stories as well? Any key stocks that have come afresh onto your radar over the last 1.5 months into the new year? Has anything looked attractive to you where you would like to put in fresh funds and build positions in, sir?
If you ask me new stock, yeah, one can consider a ITC hotel.
Okay.
Uh, as compared to discount price, or as compared to the cost the management assume, it is at a steep discount. Not just because discount, it is starting the business with 1,500 crore of cash, and there's a lot of expansions. And if you look at the enterprise value per room, this hotel looks very attractive. I would expect a lot of noise from the management in terms of expansion in the next 1 to 2 years. And I like this stock on a fundamental basis also. And this is the one stock, the new stock I can recommend.
Okay, got that. So there is something that you can actually look at. ITC hotels for all our viewers who have been looking at as an opportunity in this new stock. 170 currently, 5% lower. But this is a stock that you could probably look at into the hotels business if you are interested in. Okay, Mr. Chokalingam, then thank you so much for being with us on the show today and to detail for us what are the market trends and how should one navigate these volatile moves that one is seeing. And of course, like you said, this too shall pass and things will turn for the better after some time. Thank you so much. Appreciate your time with us. 314 points lower on the Nifty, 23,070 right now. The good part is that we've not tested the 23,000 mark. On the lower side, we tested 23,300, 23,200, 23,100 as well, but 23,000 has still remained intact, even though this is the 5th consecutive day of losses for the Nifty today. And that's a bit of a pain point. Broader markets in deeper pain, especially the small caps, which is down about 3.5% now. 3.2% decline for the mid caps as well. Realty down by 3.2%, slightly off the low point of the day. We did test, in fact, 23,000 on an intraday basis on the Nifty, but we came back. But this is a deep correction that we are seeing across the board sell off. At least there are 1, 2, 3, 4, 5, 6, 7, 8, 9, 8 to 9 sectors that are down by over 2% in trade today, apart from mid and small caps. All the sectors are down by over 1%. That's the kind of cut that you are seeing. The Nifty Bank is down by 1.2%, private banks, financial services, so no hiding place at this point. 14.9 and on the India VIX, 3.2% higher. On the PSU space, it's only Oil India that's hovering higher, 1.6% up in trade today. On the F&O space also, Oil India, Adani Enterprises remain as the top movers. On the downside, you have again PB Fintech that's lost a lot of ground today. In fact, in the F&O space, 10% down. Poonawalla FinCorp, 5.5% down. HFCL, BSC, these are the pockets that have really lost a lot of ground in trade today. When we talk about the broader markets, like I said, a whole host of stocks that are declining. Panisha Biotech, Zaggle, Goldium International, K Fintech as well, Dreamfolks, Venus Remedies. These are all the stocks that are down and out in the broader markets. What's holding up is CRISIL, 5.5% higher. Earnings impact, Sale and Exploration, Happiest Minds Technologies, Zodiac Energy, then you have DCM Limited, Red Tape. These are the pockets that are still hovering higher in an otherwise weak setup in the markets. Well, we'll just start to look at closing action now, 329. The Nifty is at 23,068. Let's actually look at the key index contributors today. That will be an important one to look at. 24 to 25 points of a downfall on the Nifty is being contributed by Reliance Industries today. HDFC Bank has contributed 23 points to the decline, L&T about 22 points, ITC, ICICI Bank and TCS are also the key contributors of the overall Nifty fall. On the positive side, 5 stocks, Adani, Trent, Grasim, Bharti Airtel and Britannia. The only 5 stocks on the Nifty that have held their ground in trade today and have moved on the positive zone. Again, on the broader index, Happiest Minds, CRISIL, Timken India, Chola Finance Holdings are the top gainers. Whereas on the losing side, KFintech, Godfrey Phillips, Elecon Engineering, BSC are those which have seen sharp cuts in the broadest index today. Mid and small caps over 3% of a fall. IT index also no support there, 1.5% fall for this one. Looking at the stocks which have hit 52-week lows, Shipping Corporation of India, Archean Chemicals, Emcure Pharmaceuticals, Birla Corp, Sterling Wilson Solar, Gujarat Gas, 5 to 7% of a decline. These are all the stocks that have hit 52-week lows today. Any ones which have a 52-week high? Only one, Kotak Mahindra Bank, that hit a 52-week high in trade today. Volume gainers included Vodafone Idea today, Zomato, Yes Bank, Suzlon, all on the lower side. And most active in terms of value included stocks like HDFC Bank, Zomato, Bharti Airtel and BSC. Mixed or a mixed note right there. Volume action, the top stock with the volumes, highest volumes today, HBL Power, CRISIL. You also had stocks like Nykaa, which had very strong volumes in trade. So that's as far as the market action for you is concerned, viewers. Do stay tuned with us even beyond the stock markets hours as well. We will continue to get you all the insight on the business and the macro front too. But do stay tuned, and tomorrow is when we will get you the entire market coverage following what has transpired overnight overseas on the US as well as early morning in the Asian market. Stay tuned with us.
Karnataka is the 4th largest automobile producing state in India, contributing 8.5% to the nation's vehicle production. The state also has the highest number of EV charging stations, boasting an impressive 5,765 public stations. We were the first to introduce an EV policy in 2017 and will soon unveil a clean mobility policy at our upcoming Global Investors Meet. Backed by our progressive policies, world-class infrastructure and a skilled workforce, Karnataka is paving the way for growth in both traditional and EV sectors. Join us at Invest Karnataka 2025 and be a driving force in the future of automotive and EV innovation.
All roads leading to Prayagraj are jammed, and literally an unprecedentedly large number of vehicles driving towards the Sangam city for the Mahakumbh clogged the national